Welcome to ForexTV.com. Today's Friday, August 7th. I'm Tim Kelly with the New York Forex Market Buzz. The greenback came soaring back on the wings of a much better than expected jobs report. U.S. stocks jumped after the unemployment rate decreased for the first time since April 2008, bolstering speculation that a recovering economy justifies the steepest rally in equities in 7 decades. Commodities are also rising and treasuries are declining. While the Labor Department released a report Friday morning showing a continued decline in employment in the month of July, the pace of job losses slowed by even more than economists had been anticipating. The unemployment rate also fell for the first time in over a year. The report showed that non-farm payroll employment fell by 247,000 jobs in July, following a revised decrease of 444,000 jobs in June. Economists had been expecting employment to fall by 325 jobs compared to the drop of 467,000 jobs originally reported for the previous month. Well, today we're joined by Marc Chandler, Global Head of Currency Strategy at Brown Brothers Harriman, and also author of Making Sense of the Dollar, Exposing Dangerous Myths About Trade and Foreign Exchange, published by Bloomberg Press. Marc, welcome to the program.
Thank you. It's a privilege.
Marc, I appreciate you taking your time out on a Friday. It's a beautiful day out. We haven't had that in a long time, and here you are talking to me, so my hat's off to you. Appreciate it. Getting started right now, you and I talked a little bit before this segment about the news coming out, and we saw the market euro and some of the risk, so-called risk trades in Forex shoot up kind of in a head fake and then sell off. Do you see this as a change in more of a macro momentum picture for the U.S. dollar? We haven't had news like this in the economy in a long time, or is this just maybe a little bump in the road and perhaps we get back to normalcy? What's your take?
Well, I tell you the truth, I've been generally more bullish to the dollar than the market has, and everything looked fine for the last 3 quarters until Q2 when the dollar suffered, and of course the dollar's begun this third quarter on weak footing. I outlined three factors that people should look at to know when the dollar has bottomed. One of them that has not fallen into place today, and I'm a little bit skeptical of this move, is that U.S. interest rates need to rise above German rates. Otherwise, investors are incentivized, they're actually paid to be short the dollar. So even though U.S. interest rates have risen sharply today, European rates have risen more, so we're still being paid to be short the dollar. That would be one thing we need to see happen for me to believe that there's going to be a sustained dollar rally. Second thing, and that's what's happening today.
Marc, let me interrupt there for a moment. When you say higher, do you mean marginally higher? Is there a spread there that we should be looking at? How much higher than the German rates does this have to go?
Well, it's not so much the exact magnitude of them, but right now the 10-year U.S. yield is a little bit above, say 20 basis points or so above the German yield. The 5 years above the German yield, but we haven't turned at the short end. At the short end, I mean, say, the 2-year notes as well as the Euribor versus the Euro-dollar futures contracts.
Mm-hmm.
And so what I'm looking at is for U.S. rates so people are no longer paid to be short the dollar. If it's flat, if U.S. rates are the same level as German rates, people can be more neutral. But right now the incentive structure generated by the interest rate differential still favors short dollar positions. Second factor I would look at is when the dollar begins rallying on good economic news like it is today. Up until now, considering the crisis, the dollar rallied beginning in the middle of last year as the crisis became more acute. When many people thought the world economy was collapsing, imploding, the dollar benefited. And as people became more optimistic beginning in this past spring, the dollar has suffered. What we need to see happening and for the dollar to sustain a rally is for one or two things to happen. Either we get a lot of bad news, which I think is unlikely, or we get some good news and the dollar begins responding positively to good news. Today is one of those days, but I'm hesitant to jump to conclusions and say that one day makes a trend. I'd like to see some follow-through. There have been other days in the past 6 months or so where the dollar has rallied in response to good economic news, but then the old pattern reasserts itself. And the third thing I would look at is just for the technical conditions. When the dollar rallies And when the dollar begins rallying, if there's a bottoming pattern, like a head and shoulders pattern, divergences in the relative strength index or other momentum indicators. And right now, I don't see a powerful technical signal except the impulsive nature of today's price action.
Well, Mark, thank you for outlining that. That's certainly something that we will need to follow up on as well. However, today you look at the sell-off in euro, the sell-off in yen. A lot. You and I also talked about this term risk aversion, and you I think rightly pointed out that risk aversion perhaps a very much overused term, because does risk aversion in a trader's mind change in 8-hour cycles or 2-hour cycles or 10-minute cycles when a piece of news comes out? We can understand that a big movement in the reduction of the jobless claims here is big, or people out of work. It was quite large today, so that could change it. But we hear this risk aversion theme being used again and again and again, mostly in the media, actually. Can you explain and give us your insight into what you think that is, and why people are calling it risk aversion or risk appetite? I think you pointed to more momentum, and I think that suggests technical analysis. But in your words, what do you make of that gyration in the markets?
That's a good question, because I think people do use this concept of risk aversion. I think that if you look back at the commentary in the market, it seems to me that there's a bit of a groupthink. About a year ago, a lot of people were talking about carry trades, and everything was a carry trade, and everything had to do with the yen carry trade. And I think that's one of these things where there might have been a kernel of truth to it initially, but it gets so overused that it sort of dilutes and sort of, I want to say, bastardizes the meaning of these words. I think that what people meant by risk aversion is that when things were going well, you can afford to buy the high-yielding currencies or the high-yielding bonds, and ideas that people have a healthy appetite to take on these risks because the higher returns is implicit, people understand, to mean higher risk as well. And so I think that many people thought that the dollar benefited in the second half of last year and Q1 of this year, because as the world began melting down, people wanted to be in the risk-free assets, which people thought at the time were U.S. Treasuries and the dollar. And then as the crisis began easing, people began moving out of the safe haven and into these riskier assets. The problem I have with that, and this is, I think, a key issue that people have to get their hands around, why did the dollar rally? Some people suggest the dollar rallied as a safe haven. But the problem with that explanation is it doesn't help explain why the Federal Reserve, one of the most successful programs the Federal Reserve had, was swap lines with foreign central banks, making dollars available to them to the tune of over $650 billion. Today, less than $100 billion is outstanding. I would suggest to you that the problem, the source of demand for dollars, is not that people wanted dollars as a safe haven, though there might have been some of that. The real driver was that people were short the dollar. European banks expanded their balance sheets by financing them with short dollar positions. Hedge funds, Russians, South Koreans, Brazilians, Mexicans borrowed dollars and brought the money back to their countries and lent it to their governments, often, or corporations, paid with a higher yield. This left them with a horrible currency mismatch, and the dollar began rallying. They were forced to buy back those dollars they previously sold. Mm-hmm. So I would not think that the market is overly long dollars. In fact, I think that, for me, one of the next legs up in the dollar will be fueled by foreign demand for U.S. equities as they rebalance and move back into weightings, more neutral weightings for indexes, and foreign direct investment comes into the U.S. chasing the high productivity and low unit labor costs of American workers.
Mark, at this point, where does that put you vis-a-vis some of the major currencies here? Let's, the whole idea of this short covering, and I buy your argument, by the way. I think it's well stated. So I want to quickly get into some ideas on where you think currency rates are going on a specific level. Let's start with euro. Right now, euro down about 100 basis points, and a little less than that. I'm sorry, but 141.84 had been flirting with that 144 level. Where do we go from here in the next couple of weeks?
In the short term, I think that it's still not clear that the euro has peaked, despite today's impulsive down move. Again, this is just a one-day move. We have gone through some good chart support levels. But again, this is just a one-day move, and I think it caught the market leaning the wrong way. So in the short term, I'm still a bit agnostic that this is really the big turning point. But by the end of the year, we're looking at the euro to be down towards 136. And the same thing goes for these other currencies. I think the yen is the one I feel the safest about, in that the dollar-yen has bottomed for the year, and that we've taken out a very important trend line connecting the March highs and the June highs, or early July highs, and that comes in today around 96.30, and right now we're trading 97.65. I think that the yen will finish the year closer to 102. But I think that what we deal with in currency markets is really a relative aspect of things. And so I think that even if many people are still skeptical about the U.S. economy, what underlies my optimism about the dollar is sort of a story about these two boys who are being chased by a tiger. And one of the boys stops and puts on a pair of gym shoes. And his friend says to him, "You're not going to outrun the tiger just because you put on gym shoes." And his friend says to him, "I don't have to outrun the tiger, I just have to outrun you." And so I think that what that means to me
yeah.
is that as the challenge of the U.S. economy may be, as challenge that the Federal Reserve and the Treasury may be with supply and trying to normalize monetary policy at some juncture, other countries are a lot worse off. Europe is still very slow. Their economic downturn was steeper than ours, and we are likely to see a strong Q3, the current quarter economic GDP print, while Europe is still contracting. They are a good 6 months behind us. So I think the dollar benefits from that. Japan, even though Japan might post a positive Q2 GDP, the economy is moribund. They have rising deflationary pressures, rising unemployment, and a shrinking population. This is not a good mix in Japan, a very strong deflationary forces, and yet the yen has, until very recently, been extremely strong. It's appreciated by roughly 30% in the past 2 years.
Yeah, that's a tough situation they're faced with there. It's almost unprecedented. Who thought it could get worse in the lost decade? But it's not looking good there, is it?
No, I think that Japan's got some problems ahead of it, and of course, another sort of monkey wrench in the works, of course, is that they have an unelected prime minister who goes to the polls later this month and is likely to lose. It would be the first time. The LDP, the ruling Liberal Democratic Party in Japan, has held power for more or less 50 years, with a brief exception, and they're likely to be thrown out of office now.
Tough times, challenging times, and unprecedented times, no doubt. Mark, I want to jump over to one area of commodity currencies, including Aussie and Canada. Australia, land of Oz. What do you see there in store for the Australian dollar? It seems that they technically did not enter this recession. Demand out of China is pretty strong. It's their number one trade partner. Things are looking pretty rosy there. Where do you see Aussie dollar going vis-a-vis the U.S. dollar?
Sure, I'm relatively bullish Australian dollar. I think they'll be among the first countries to raise interest rates, major industrialized countries. They've had the Reserve Bank of Australia has indicated as much. I think it's largely priced in. The market might be getting ahead of itself, like they are with the Fed funds. Right now, the market is pricing a 25 basis point rate hike from the Reserve Bank of Australia before the end of the year, and the market is leaning towards an early 2010 rate hike by the Federal Reserve. And on both counts, it seems to me a little bit exaggerated. Australia has a better chance. I would personally play down the commodity, thinking about Australian dollars as a commodity currency. I think if one could do correlations, looks at relationships between, say, gold, oil, S&Ps, one would find that the euro is actually more correlated to those commodities than the Australian dollar. But Australia has other factors that benefit it. One, as we mentioned, didn't go into recession technically, and so they still have higher interest rates. I believe their base rate's at 3%. That's quite good compared to the kind of rates you get in Europe or the U.S. for that matter, especially from a Japanese point of view. Also, what they have, as you mentioned, the proximity to China. It also involves the trade side, which of course is commodities, but it's not so much the price of commodities as just increasing demand for Australian goods to help service the Chinese economy. So that's also another positive for it. Thirdly, I think because it's seen to be an alternative to the dollar, one of those, I think we were talking about before with risk assets, Australia seems to be a bit riskier than, say, the U.S. dollar or the euro. So for momentum purposes, on these risk aversion type trades, Australian dollars benefited. We're trading right now, as you mentioned, just below 84 cents, and we think we can finish the year closer to 86 cents. Not a big move. A lot of good news is already priced in there.
Okay. Hey, Mark, let's leave it there. I want to take a couple of minutes to talk about your book here. No, I don't have a copy here. Mine must have got lost in the mail, but I do have a picture of it, and it's called Making Sense of the Dollar, Exposing Dangerous Myths About Trade and Foreign Exchange. Now, as I said, I haven't read the book, but would love to hear about what this is about and who should be reading it.
Sure. Thank you very much. The book is the basis of the book. I look at myths about trade and foreign exchange, and I look at 10 myths. Each chapter is a standalone argument. So, for example, one of the chapters is that one of the myths is that people think that the large U.S. trade deficit, like people like Martin Wolf of the Financial Times, Bill Gates, Warren Buffett, these very smart people say that the U.S. trade deficit is the road to ruin, that the U.S. has become poorer because of it. And so what I do is I look at the trade deficit from different perspectives, and I find, for example, one of the nuggets, for example, is that over half the U.S. trade deficit can be accounted for by the movement of goods within the same company. For example, General Motors making a braking system in Ontario, Canada, exporting it back to GM in Detroit. The government tells me that's a trade deficit. I say that's what globalization means, moving goods from one side of the factory floor to the other, and it just so happens that the 49th parallel weaves in and out of that factory floor. So I look at that and I say, if that's half the trade deficit, is the trade deficit really making us poor? And so I think that Bill Gates, Warren Buffett, Martin Wolf, to some extent, when they talk about these trade issues, they're very much like mercantilists. Like the key to the wealth of nations is that you're on a trade surplus. And yet, Adam Smith, over 200 years ago, said that's not the way countries become rich. Countries become rich because they have extensive division of labor, and which helps promote productivity. And that's one of the, I think, the ironic things here in the United States is right now, despite the large trade deficit, productivity has actually gone up during this recession. And so that's be one of the myths. Another myth I look at, for example, is that the globalization has deindustrialized the United States. This is a very common myth, even among the labor unions. And when you really look at the numbers, you find that before this recession, the U.S. was producing more goods. Factory output was higher than ever before. What's really happened?
Well, Mark, we're still the number one exporter of goods in the world, are we not?
Yeah, so I don't know if we're the top one right now, but we're in the top three. The U.S. is up there, China is up there, and as well as Germany. But that's one of the myths of the book, though, what I try to argue is that the U.S. does not service foreign demand primarily by exporting. I would suggest that, in sort of Donald Rumsfeld's words, that's an old European answer. The American answer is build locally, sell locally. So you're right, the U.S. might export this year, say, $1.2 trillion worth of goods. But our sales by the majority-owned affiliates of U.S. multinationals will sell over $4 trillion worth of goods this year. Our contribution to empires, the real way the U.S. services markets, build locally, sell locally.
Okay.
So this shifts the focus then from a trade-oriented policy to an investment-oriented policy.
Okay. Mark, I'd love to get a little bit more in depth on this, and perhaps we will, but that's about as much time as we have today. I really appreciate you sharing ideas about your book. I am going to read it for sure, and I would suggest that anybody trading in Forex check it out. With all the information coming out, this is one way to make sense of it. Mark, we've known you for a long time, so I'm looking forward to that read. Thanks for joining us today.
Thank you very much.
This has been your New York Forex Market Buzz with Marc Chandler, Brown Brothers Harriman. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.